Ind AS 7 Cash flow statement. What is the statement of cash flows? Cash flow statement is a statement which provides the details about how the cash is generated during the particular reporting period and how it is applied. How to prepare the cash flow statement? Consider opening balance of cash and cash equivalents, add cash generated, deduct cash payments, and reconcile it with the closing balance of cash and cash equivalents. Next, cash. Cash includes cash in hand and demand deposits. Cash equivalents. Cash equivalents are short term, highly liquid investments that are readily convertible to known amount of cash and which are subject to an insignificant risk of changes in values. Therefore, an investment normally qualifies as a cash equivalent only when it has a short maturity of 3 months or less from the date of acquisition. Equity investments are excluded from cash equivalents. That means equity investments are not considered as a cash equivalents. Next up, bank borrowings are generally considered to be financing activities. However, where bank overdraft, which are repayable on demand, form an integral part of entities' cash management, bank overdraft are included as a component of cash and cash equivalents. So, bank borrowings are financing activities, and bank overdraft is cash and cash equivalents. A characteristics of such banking arrangement is that bank balance often fluctuates from being positive to overdrawn. Classification of cash flows. Cash flows are classified into three categories: cash flows from operating activities, cash flow from investing activities, cash flow from financing activities. First, cash flows from operating activities. Cash flows from operating activities are primarily derived from the principal revenue producing activities of the entity, that is, from operations of the business. Therefore, they are the result of the transactions that enter into the determination of profit or loss. Examples: operating cash inflows, cash receipts from sale of goods and services, cash receipts from royalty, fees, commission, and other revenue, cash receipts and payments to an insurance entity for premiums, claims, annuities, etc., cash receipts and payments from contracts held for dealing or trading purpose. Next, operating cash outflows examples: cash payments to suppliers for goods and services, cash payments to and on behalf of the employees, cash payments or refunds of income taxes, unless they can be specifically identified with financing and investing activities. Certain specific issues: profit or loss on sale of assets. The cash flows relating to such transactions are cash flows from investing activities. Therefore, profit or loss on sale of assets is an investing activity. Next, properties built for let out. Cash payments to manufacture or acquire assets held for rental to others and subsequently held for sale are cash flows from operating activities. That means it is pertaining to main business. The cash receipts from rents and subsequent sale of such assets are also cash flows from operating activities. Therefore, properties built for let out, they are operating activities only. Next, operations of financial companies and banks. An entity may hold securities and loans for dealing or trading purpose, in which case they are similar to inventories acquired specifically for resale. Therefore, cash flows arising from purchase and sale of dealing or trading securities are classified as operating activities. Similarly, cash advances and loans made by financial institutions are usually classified as operating activities since they relates to main revenue producing activities of the entity. Therefore, operations of financial companies and banks are operating activities. Next, cash flows from investing activities. Cash flow from investing activities represent the extent to which expenditures have been made for resources intended to generate future income and cash flows. That is, activities that result in acquisition and disposal of long term assets and other investments not included in cash equivalents. Only expenditures that results in a recognized asset in the balance sheet are eligible for classification as investing activities. Examples of investing activities: investing cash inflows, cash receipts from sale of PPE, intangibles, and other long term assets, cash receipts from sale of equity or debt instruments other than those considered to be cash equivalents and those held for dealing or trading purpose, cash receipts from repayment of advances and loans other than by financial institution, cash receipts from futures, forwards, options, swaps, contracts, except when held for dealing or trading purpose, other receipts are classified as financing activities. Next, investing cash outflows examples. Cash payments to acquire PPE, intangibles, and other long-term assets. Cash payments to acquire equity or debt instruments other than those considered to be cash equivalents or those held for dealing or trading purpose. Cash advances and loans given other than by financial institution. Cash payments for futures, forwards, options, swap contracts, except when held for dealing or trading purpose, or payments are classified as financing activities. When a contract is accounted for as a hedge of an identifiable position, the cash flows of the contract are classified in the same manner as the cash flows of the position being hedged. Next, cash flows from financing activities. The cash flows relating to raising of funds and redemption of funds will be covered under cash flows from financing activities. The cost of capital is also generally covered under financing activities. Financing cash inflows. Cash proceeds from issuing shares or other equity instruments. Cash proceeds from issuing debentures, loans, notes, bonds, mortgages, and other short-term or long-term borrowings will be fall under financing activities. Next, financing cash outflows. Cash payments to owners to acquire or redeem the entity's shares, cash repayments of amounts borrowed, cash payments by a lessee for the reduction of the outstanding liability relating to finance lease. Next, reporting of cash flows. Under that, reporting of cash flows from operating activities, direct method, indirect method. Direct method. In this method, major classes of cash receipts and gross cash payments are disclosed. Direct method starts with cash revenue or income or receipts of the company. All the cash expenses will be deducted from such cash revenue. The cash profit will be adjusted for the cash flows arising from investing and financing activities. Non-cash expenses or losses or gains will not be considered. The payments to suppliers and receipts from customers are also taken into consideration. The resultant figure would be cash flow from operating activity. Thus, direct method will have top-down approach. Top-down approach. Indirect method. Indirect method is the reverse of direct method. It starts with the accounting profit after tax, that is accounting PAT, as given in profit and loss accounts. Thereafter, the profits will be adjusted for non-cash items, losses and gains on investing and financing activities, interest and dividends, collections and payments to debtors or creditors, etc. Accordingly, the cash flow from operating activity will be derived. This indirect method will have bottom-up approach. Under both the methods, the amount of cash flow from operating activity need to be necessarily the same. It's only the approach for presentation which differs. Next, reporting cash flows from investing and financing activity. An entity is required to report separately major class of gross cash receipts and gross cash payments arising from investing activities and financing activities, except to the extent that cash flows are permitted to be reported on a net basis. The presentation of cash flows from investing activities and financing activities is same under both direct method and indirect method. Next, reporting cash flows on a net basis. If nothing is specifically mentioned, then as per Ind AS 7, the cash flows will be presented on gross basis only. Gross basis means receipts would be shown separately and the payments would be shown separately. For example, if in the year 21-22, some land is purchased for 2.5 crores and another land is sold for 3.5 crores, then while presenting the information, the entity shall show separately the outflow of 2.5 crores and inflow of 3.5 crores. The above base has following exceptions. That is, cash flows arising from the following operating, investing, or financing activities may be reported on a net basis. In following cases, example, acceptance and repayment of demand deposits of a bank, funds held for customers by an investment entity, rents collected on behalf of and paid over to the owners of the properties, cash receipts and payments for Items in which the turnover is quick, the amounts are large, and the maturities are short. Principal amounts relating to credit card customers, purchase and sale of investments, cash receipts and payments for the acceptance and repayment of deposits with a fixed maturity date, cash advances and loans made to customers, and the repayment of those advances and loans. Next, foreign currency cash flows. Cash flows arising from transactions in a foreign currency shall be recorded in an entity's functional currency by applying exchange rate at the date of the cash flow. Cash flows of foreign subsidiary shall be translated at the exchange rates at the dates of the cash flows. Example, suppose the money is received on account of exports on 15th January 2017 in US dollars. The company prepares the account in rupees. In such case, the exchange rate between USD and rupees as on 15th January 2017 needs to be applied for conversion. Next, unrealized gains and losses arising from changes in foreign currency exchange rates are not cash flows. However, the effect of exchange rate changes on cash and cash equivalents held or due in a foreign currency is reported in the statement of cash flows in order to reconcile cash and cash equivalents at the beginning and at the end of the period. This amount is presented separately from cash flows from operating, investing, and financing activities and includes the difference, if any, had those cash flows been reported at the end of the period exchange rate. Period exchange rates. Next, treatment of foreign exchange difference arising from unsettled transactions relating to operating activity. Under indirect method of preparation of statement of cash flows, the exchange difference that arise on translation at the balance sheet date for monetary items that form part of operating activities will require no adjustment in the reconciliation of profit to net cash flow from operating activities. Example, India entity A, Indian company purchased goods for resale from France during January for euro 10,000. Exchange rate is 1 euro equals to rupees 70 on a credit period of 4 months. It accounted for the purchase of inventory at rupees 7 lakhs. How 7 lakhs? 10,000 into 70. On 31st March, the exchange rate has changed to 1 euro equals to rupees 65. This would mean an unrealized gain due to exchange fluctuation of rupees 50,000 since the payables will be recorded at 6,50,000 at closing exchange rate. Assume that inventory is unsold at that date. The movement is reported as under. Profit will be 50,000 less increase in inventory 7 lakhs, add increase in payables 6,50,000. Net cash flows from operating activity will be zero. Next, interest and dividends. Cash flows from interest and dividends received and paid shall each be disclosed separately. Next, in case of financing company, interest paid will be cash flows arising from operating activity as it is their core business activity. Next, interest and dividend received will be the cash flows arising from operating activities as this is their core business activity. Dividends paid, cash flows from financing activity as they are cost of obtaining financial resources. Next, in case of other company, interest paid will be the financing activity as they are cost of obtaining financial resources. Interest and dividend received will be investing activity as they are returns on investments. And dividend paid will be financing activity as they are cost of obtaining financial resources. Next, tax on income. Cash flows arising from tax on income shall be separately disclosed and shall be classified as cash flows from operating activities unless they can be specifically identified with financing and investing activities, in which case the tax cash flows is classified as financing or investing activity as appropriate. Generally, income tax paid will be operating activity. If tax is pertaining to operating or investing activity, then tax amount paid will also fall under operating or investing activity as the case may be. Next, investment in subsidiaries, associate, and joint venture. When accounting for an investment in associate, joint venture, or a subsidiary accounted for by use of equity or cost method, an investor restricts its reporting in the statement of cash flows to the cash flows between itself and the investee. For example, dividends and advances. An entity that reports its interest in an associate or joint venture using the equity method include in its statement of cash flows the cash flows in respect of its investments in the associate or joint venture, and distributions and other payments are receipts between it and the associate or joint venture. Next, changes in ownerships, interest in subsidiaries and other businesses. Classification of cash flows as investing activity. The aggregate cash flows arising from obtaining or losing control of subsidiaries or other businesses shall be presented separately and classified as investing activities. An entity shall disclose, in respect of both obtaining and losing control of subsidiaries or other businesses during the period, each of the following: total consideration paid or received, portion of consideration consisting of cash and cash equivalents, amount of cash and cash equivalents in the subsidiaries or other businesses over which control is obtained or lost, and amount of assets and liabilities other than cash and cash equivalents in the subsidiaries or other businesses over which control is obtained or lost, summarized by each major category. Classification of cash flows as financing activity. Cash flows arising from changing changes in ownership interests in a subsidiary that do not result in a loss of control shall be classified as cash flows from financing activities unless the subsidiary is held by an investment entity and is required to be measured at fair value through P&L, FVTPL. Non-cash transactions. Investing and financing transactions that do not require the use of cash or cash equivalents shall be excluded from statement of cash flows. Examples of non-cash transactions: acquisition of assets either by assuming related liabilities, directly related liabilities, or by means of finance lease. Acquisition of entity by means of equity issue and conversion of debt to equity. These are the examples of non-cash transactions. Next, discloses as per Ind AS 7. An entity shall disclose the components of cash and cash equivalents and shall present a reconciliation of the amounts in the statement of cash flows with the equivalent items reported in the balance sheet. It has been clarified that bank overdraft in the balance sheet will be included within financial liabilities just because the bank overdraft, which are repayable on demand, is included in cash and cash equivalents for the purpose of Ind AS 7 doesn't mean that the same should be netted off against the cash and cash equivalent balance in the balance sheet. Instead, Ind AS 7 requires a disclosure of the components of cash and cash equivalents and a reconciliation of the amounts presented in the cash flow statements.